Here's a question. If you could only buy and hold one stock for the next 50 years, what would it be? Most investors, including even Warren Buffett Kung Kung himself, likes to say that their favorite holding period is forever. And yet, this is easier said than done. It is already difficult to predict what will happen 10 years from now, much less trying to forecast which is still a good stock to hold 50 years from now. In fact, the average lifespan of a company on the S&P 500 used to be around 30 years. Today, it has declined to 15 years. So the idea of buying a stock and holding it for half a century sounds almost unrealistic. But I still want to try and answer this question. And to do that, we need to first understand what makes a company truly long-lasting. Here, we have a chart showing the rolling 10 years annualized returns of the S&P 500. These returns can be broken down into three components. The first component is dividends, shown in blue. Dividends are always positive because they are a cash distribution. Over time, however, their contribution has declined. In the last decade, dividends have contributed roughly 2% per year to total returns. The second component is valuation change, also known as multiple expansion or contraction. This reflects how much investors are willing to pay for $1 of earnings. When the sentiment improves, multiples can rise and boost earnings. But when sentiment worsens, multiples can fall and drag returns lower. This component is highly unpredictable and can swing between positive and negative, even when the business itself has not changed much. And finally, the third component is earnings growth, which is shown in green. Looking at the chart, you can see that earnings growth is consistently the largest contributor to long-term stock returns and is rarely negative over a 10-year period. The two exceptions were during the Great Depression in the 1930s and the period ending around the global financial crisis in 2008, where earnings growth was negative. So what does this tell us? This tells us that if you want to find a company that can perform well 30, 40 or even 50 years from now, the most important thing to focus on is whether the business can continue to grow its earnings over multiple decades, not dividends, not valuations growth, but earnings growth. Here's another chart that shows the same idea. Over a one-year period, the biggest driver of stock performance is valuation change. For example, last year, United Health was on a large drawdown from the start of the year till July. This was not because the fundamentals of the company turned bad, but rather, it was largely due to negative sentiment. Investors were concerned about higher medical costs, regulatory uncertainty, and margin pressure in the insurance business. But then, when it was announced that Berkshire Hathaway bought the stocks, it effectively got the seal of approval from Warren Buffett himself. Over the following months, the stock rebounded by more than 30%. United Health's earnings definitely did not suddenly jump by 30%, but rather, what changed was the confidence. Investors were simply willing to pay a higher multiple for the same earnings. So over the short term, stock prices are driven largely by sentiment and valuation. But as the time horizon stretches out, that effect fades. By the 10-year mark, revenue growth explains roughly 74% of total stock returns, while margins, valuation changes, and even free cash flow become far less important in comparison. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Now, of course, this rule does not always hold perfectly. There are a small number of companies that deliver strong long-term returns even without much revenue growth. A good example is Coca-Cola. Over the past 10 years, Coca-Cola's revenue has been largely flat, and yet when you include dividends, the stock is up by about 141%. One reason is margin expansion. Over a decade ago, Coca-Cola's operating margin was around 22%. Today, it is closer to 30%. The company also benefited from multiple expansion. In the past, Coca-Cola was trading at roughly 13 times earnings. Today, it is trading closer to 21 times earnings. Another example is McDonald's. Over the past 10 years, McDonald's revenue also did not grow by much. And yet, including dividends, the stock is up by roughly 350% over the same period. Here again, margin expansion played a major role. Over the last decade, McDonald's operating margin increased from around 30% to 45%. At the same time, its valuation expanded significantly, with the price to earnings ratio rising from roughly 12 to 26. So, what was Coca-Cola and McDonald's able to achieve that most other companies can't? The short answer is that they have moats that do not depend on technology cycles. For Coca-Cola, the moat is its brand recognition, global distribution network, and loyalty. Coca-Cola is not just a soft drink, it is a default choice. When people walk into a store, order at a restaurant, or attend an event, Coca-Cola is often already there. That level of familiarity and trust is built over decades and is reinforced every day through availability, marketing, and consistency. For McDonald's, the moat is its scale, real estate, and its franchising model. McDonald's controls some of the best fast food restaurant locations globally, often in high traffic areas. Its franchise system allows it to align its incentives with its operators, while standardized operations ensures consistency across markets. This allows McDonald's to raise prices gradually, improve efficiency, and protect margins, all without losing customers. Now contrast that with companies like Oracle, IBM, or Nokia. These are the companies that once held dominant positions and delivered strong earnings growth over long periods of time, but their moats were tied to specific technologies or architectures. For Oracle, its advantage was built around proprietary databases and licensing models. IBM dominated enterprise hardware and IT services, while Nokia led in mobile phone hardware and manufacturing. But when software moved to the cloud, computing shifted to hyperscale data centers, mobile phones transitioned from hardware-centric devices to software ecosystem. These companies didn't adapt fast enough and they eventually got disrupted. What this tells us is that long-term winners need more than just revenue growth. They also need moats that are able to protect their earnings, and more importantly, they need a business DNA that allows them to continue staying relevant as the industries evolve. So with that few criteria in mind, I've narrowed the list down to just a few names. One of the first companies that stood out was S&P Global. Most people know S&P Global because of the S&P 500 index, but it is not actually the core of the business. S&P Global is in the business of data, benchmarks, and credit ratings. It sits behind global capital markets, providing the information and standards that investors, governments, and institutions rely on to function. This is a business with very few competitors. Indices, ratings, and financial benchmarks benefit heavily from scale and trust, which makes them extremely difficult to disrupt. However, the reason I did not pick S&P Global ultimately comes down to growth. While S&P Global is a very high quality business, its growth is closely tied to the expansion and health of the global financial markets, which tends to grow roughly in line with the economy over time. Personally, I wanted a company that could provide me with potentially higher returns. Another strong contender is Costco. Costco is not just a retailer, it is a membership business that's built around trust and consistently low pricing. Costco keeps its product margins intentionally low and passes those savings back to customers while earning most of its profits from membership fees. With this model, Costco is able to create strong loyalty and extremely high renewal rates. Today, Costco's footprint is still heavily concentrated in the US and Canada, with relatively limited international expansion so far. So, as long as Costco can continue to earn trust and grow its membership base globally, its earnings can continue to compound steadily. However, the trade-off is that retail remains a highly competitive industry. Even though Costco's model is difficult to replicate, competition from players like Amazon can still pressure pricing and growth, which may cap how fast Costco can scale over a long time horizon. Then we also have payment networks like Visa and MasterCard. These companies benefit from global acceptance and the long-term shift from cash to digital payments, and they earn a small fee each time money moves across their networks. So as long as global commerce is able to continue to grow, these networks will remain highly relevant and profitable. But again, my issue is more to do with their growth rates. Then there is Alphabet or Google. Google is currently one of the most dominant businesses in the world. It sits at the center of how people access information, watch content, navigate the world, as well as how businesses advertise. Its scale, data advantage, and distribution across search, YouTube, Android, and Chrome give it an enormous moat. However, the reason I did not ultimately pick Google comes down to uncertainty around how its core business will evolve. While I am confident that advertising will still exist decades from now, I'm not sure about how advertising will be delivered and monetized as interfaces shift towards AI assistants, agents, and automated actions. Now, to be clear, I believe there is a high likelihood that Google will be able to continue to keep up. The company is actively pushing out new products and experimenting aggressively, from AI models and search integration to long-term bets housed under Google Labs, such as Pomeli, Project Disco, and many other research initiatives. Not only that, Google is also very aware of the innovator's dilemma. Unlike many past incumbents such as IBM, Oracle, and Nokia, Google is willing to disrupt its own products before someone else does. That said, given that the world of technology is changing rapidly, even with strong execution, it is still hard to predict how Google's business will evolve over several decades. So after weighing all these great businesses, the company I ultimately settled on is Amazon. The first reason I picked Amazon is that its business is built around activities that people and businesses will keep doing no matter how technology changes. People will continue to buy goods, businesses will continue to run software, and companies will still need logistics and computing power. Amazon is deeply embedded into all of that, and not just relying on a single product, trend, or way of using technology. This is unlike Google, which depends a lot on how people access information and how intent is monetized. For example, if people move from typing search queries to relying on AI assistants that complete tasks automatically, Google has to redesign how ads are shown and how advertisers are paying for those outcomes or risk being disrupted. In contrast, Amazon does not face that issue. Whether a purchase is triggered by a website, an app, or an AI assistant, the order still has to be fulfilled, stored, shipped, and paid for. As long as that transaction runs through Amazon's ecosystem, Amazon will continue to earn money, even if the front-end experience changes completely. The second reason is AWS. AWS is one of Amazon's largest profit engines and is an important piece of global digital infrastructure. Businesses rely on it to run websites, software, databases, and increasingly AI workloads. This demand is likely to be around far into the future. Even if the way people use apps, search, or shop changes completely, businesses will still need compute, storage, and cloud services to operate. That allows AWS to remain relevant and valuable for decades to come. In contrast, Google earns most of its money from advertising, but as those behaviors change over time, Google has to continuously adjust how it monetizes. The fourth reason is that Amazon has multiple independent growth engines. While Google has multiple revenue sources too, they are still largely variations of the same thing. Google earns from search advertising, YouTube advertising, and its advertising network across the web. In contrast, Amazon's revenue is far more diversified. It earns from first-party and third-party retail, fulfillment and logistics services, AWS cloud computing, advertising tied to purchases, Prime subscriptions, as well as increasingly from areas such as grocery and physical retail. These businesses do not all move at the same direction at the same time. When retail margins are under pressure, AWS or advertising can help to carry profits. Or when cloud growth slows, services and subscriptions can help to pick up the slack. And more importantly, Amazon has already demonstrated that it has the ability to shift to where growth and profitability comes from. This level of diversification can help to reduce the risk that any single change in technology or consumer behavior derails the entire business. This is especially important when we are looking over a 50-year horizon. Last but not least, Amazon has the reinvestment discipline. While many companies choose to optimize for quarterly profits, Amazon has a long track record of sacrificing short-term profitability to build long-term infrastructure. For example, it has repeatedly reinvested cash flow into warehouses, fulfillment centers, logistic networks, data centers, and custom chips, often years before the payoff become visible. And while many of these investments look excessive or even inefficient over the short term, over time, they can turn into durable advantages that help Amazon to lower costs, improve speed, as well as making the company stay competitive and relevant over the long term. So there you have it. If I could only buy one stock to hold for the long term, Amazon would be my choice. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.